Intro to Sales and Trading by John Potter. So first off, what is sales and trading? Sales is the process of selling financial instruments, and as we learned from the first video, a financial instrument is just any asset that can be created, traded, or modified. Trading is the buying and selling of financial instruments on financial markets or in financial markets. And then financial markets um, are so important because they provide liquidity, capital, and participation that are so essential for economics and economic growth. First off, what are the types of sales? So the most common types are institutional, which is transactions between large organizations such as banks, corporations, governments, or funds that involve high value products or services. So an example of this would be B2B marketing, um, or B2B sales, which is just business to business sales. That means a business is buying or paying another business to sell their good. So the next type is retail. This includes consumer goods or final goods by businesses to end consumers, and then includes in-store sales as well as online sales as well. So an example of this would just be supermarkets or clothing stores, stuff that we as consumers would normally buy from. And then next is high net worth individuals, which is someone who generally has liquid assets of at least $1 million after accounting for their liabilities. And this would include any celebrities or athletes, anybody who is a high net worth individual. So next, the types of trading. The first one would be equity, which is the buying and selling of company shares or stocks, also known as equities on the financial market. An example of this would be when a professional might call your bank and ask to buy 1 million shares of a particular company stock. Then you can see what price you can offer. Will be an example of equity trading. Next would be fixed income trading, which is the buying and selling of fixed income securities by fixed income investors. Um, the most popular example of this would just be bonds on the stock market. Next is forex trading, which is any foreign exchange, refers to the global trading of securities and currency derivatives. So a currency quote pair would be, say, USD to GDP. Um, and that relation between the currencies is known as a currency pair. So for every $1, each Great British Pound would be worth $1.15, and that describes a forex trade. Derivative trading is when traders speculate on future price action of an asset via the buying and selling of derivative contracts. And then lastly, commodities trading is the international trade in primary goods, such as goods that are raw or partly refined materials whose value mainly reflects the cost of finding, gathering, or harvesting them. So this makes sense because commodities like gold and oil, they're paid in how long it takes to find them, gather them, or harvest them, which would make sense. Next is common trading platforms. First one would be the Bloomberg terminal, which is very famous. It's fast access to news, data, and unique insight and trading tools make it one of the best and most common trading platforms. It's the most popular. It's very transparent and it's very easy to read. Next would be Thomson Reuters Econ. This covers 99% of global market cap across 150 countries. Direct access to source filing for verification also. Next would be electronic communication networks. These are also known as ECNs. These allow brokerages and investors in different geographic areas to trade without a third party involved. This platform is best for privacy and trading outside of office hours. So if you don't want that third party, it's better for privacy, and then you can also trade outside of office hours with ECNs. And all three of these are the largest and most common trading platforms known for monitoring and analyzing financial information currently. Next would be buy side versus sell side. Um, the financial market is split into two sides, buy side and a sell side, which each have different operations within them. So the buy side is a side of the financial market that buys and invests large portions of securities for the purpose of money or fund management. This is all about analysis, purchases, and investments. Some examples are asset managers, hedge funds, and pension funds. The sell side, which is the other side of the financial market, this deals with the creation, promotion, and selling of traded securities to the public. So this deals with companies that are looking to create liquidity, build relationships, or raise capital. Examples of these would be investment banks or brokerage firms is the most common. Lastly, we have the regulatory environment, which is very important in sales and trading for all acts for all areas of finance, in that matter. But the first one is compliance. This is just adhering to regulations set by financial authorities to ensure fair and transparent market practices. So two examples of these would be the Dodd-Frank Act, which was put in place to prevent excessive risk taking that could lead to a financial crisis. So that's a very common one you will see in a lot of financial classes or courses. Next will be Basel III. This is an international regulatory framework for banks, so specifically for banks. And then next you have reporting, which is the maintaining of accurate records and reports to meet regulatory requirements and ensure accountability. So this is just making sure you're keeping up to date with all the reports or information on your company to make sure you're not accidentally lying about any falsified reports or anything like that. And thank you.